SBI has reported a net profit rise of 52% year-on-year at 4,189 crore rupees for the second quarter of the current fiscal year. In our Ideas for Profit today, we'll discuss what should investors do now post the Q2 earnings of SBI. Well, the earnings growth was mainly aided by a healthy rise in loans, better margins, and lesser provisions. Now, the bank's core pre-provisioning operating profits, excluding the one-offs, that's a stake sale in the subsidiary SBI Life Insurance, increased 12% year-on-year, indicating that reasonably good operating performance was there in Q2. Now, disbursements were significantly higher across different product categories in the retail segment in Q2 FY21 on a year-on-year basis, indicating that the business is returning to normalcy. Now, the overall credit growth in the retail segment has bounced back to pre-COVID levels. Now, retail loans increased by 15% year-on-year in Q2. The corporate advances growth was muted at 3%. The gross NPAs, or the gross non-performing ratio, at trending downwards to 5.28% in Q2 on account of the Supreme Court stay on asset classification. Without the Apex Court's intervention, however, SBI's GNPA on a pro forma basis would have been higher at 5.88%. Now, the asset quality may not turn out to be as bad as was feared at the beginning of the pandemic. Moreover, the bank's high provision coverage ratio above 80% is quite comforting. Now, the management estimates that the slippages along with restructuring for FY21 would be around 60,000 crore rupees, which is equivalent to 2.5% of advances. Now, the bank is also carrying additional provision of say 7,000 crore rupees, 12% of the guided slippages, which can further increase in the second half of FY21. Now, the most encouraging fact is that the collection efficiency of the domestic loan book, excluding the agricultural segment, was at 97% in Q2 FY21. The net interest income, that's NII, jumped 15% year-on-year. The negligible interest reversal due to lower slippages also supported the growth in NII. Now, the bank saw a robust growth of 14% in deposits. The CASA and the term deposits grew by an impressive 15% and 14% respectively. The bank remains adequately capitalized with Tier 1 capital ratio at 11.9% as of September. Now, it doesn't see any urgent need to raise capital as long as the capital ratios stay 100 basis points above the regulatory requirement. Moreover, the bank also has a strong visibility of the internal accruals of profits over the next 2 years, which in turn will enhance the capital ratios. Now, SBI is well equipped to navigate the crisis induced by the pandemic. Given the kind of sheer size it has, the balance sheet of 42 lakh crore rupees as of September, also it has adequate capitalization, strong liquidity, low cost of funds, limited potential slippages and restructuring, and also legacy corporate stressed accounts fully identified and well provided for, and an ability to raise the funds by divesting its stakes in the subsidiaries that it has. What one really must note is that in spite of these trends, SBI has been one of the biggest underperforming stocks. Now, with the financial sector really looking relatively upbeat in the current time, we do expect the stock to outperform. Improving performance of its bank subsidiaries also should really help boost the sentiment going forward from here. Now, looking at the valuations at the current market price of say 207 rupees, the valuation of the stock is significantly below FY22 estimated core book value and is also pricing in most of the concerns. So, investors buying SBI stock at the current market price are getting its valuable subsidiaries for almost free. So, that's something you need to note. The stock's relative underperformance and rock bottom valuation does present a good tactical opportunity for investors.